Good morning, everybody. Welcome to Monday Morning Coffee with Kyle and Ann. Kyle and I are here with a new face. If you watch us regularly, you will recognize that we have Carol Ann Bozarth with us. She is our key mortgage expert and ready to tell us everything that's going on with mortgages because that is a huge topic today. So, welcome.
Good morning.
We've lost our names, Ann.
Well, that's because I didn't have Carol Ann and it went weird, and so I took it off. Yeah. So I'm in Rossley.
Kyle Harvey.
Carol Ann Bozarth.
Yeah, there you go. Look at that introduction. Kyle and I sell real estate for Baird Mortar in downtown Chicago, and Carol Ann is with Key Mortgage. And we're going to do our typical run through today, guys. We're going to start with statistics like we always do. It'll be a little bit different today. And then we're going to really dig deep into mortgages. And we have some questions for Carol Ann. We're going to put her on the hot seat and ask her everything you want to know about what's going on in mortgages. So that's what's shaking.
And I might have some answers.
She does.
All right, so let's, oh golly, I've got a new screen set up, so I've got to get organized here. Bear with me, everybody. Wait, there we go. All right, so we're going to talk stats really quick. I want to get through this quickly so that we can move on. Okay, single family homes first. Let me remove the coffee cup in case there's anything important underneath. All right, year-to-date sales, if you remember from last week, we are up on single-family homes. This, despite the fact that we have no inventory. I did pull this stat, ladies. This is the last 14 days. So we can see up-to-date through September, and this is the Lakefront communities. 82 homes have come on the market. 59 have gone under contract, and 38 closed. So I like the pie when it looks like that because I don't have it here. This is what happens when I go out of order. Okay. So the point is, Kyle, you help me out here.
Well, 82, a lot we discussed last week for people who watched us last week, 82 of the news are news and canceled. So there are relists.
There are some reasons. Although I have to tell you, I went through, okay, this is how I prepared, but I'm sorry, I have no visual for you. Of those 82, only 5 were relists.
Oh, interesting.
Yeah. Wow. I went through and I compared market time versus total market time. Yeah. I was really shocked by that. So guys, we are at an all-time low in inventory. At least we were as of the end of August. And when I did these stats and you saw the long thing last week, there were only like 180 homes on the market in all of the Lakefront communities. So for 82 to come on, that's a really good sign. I think a lot of people were holding off for the fall market. 59 going under contract, though, of 82 new is very, very strong.
Yes. Why are 28 on the private network? Why on earth would you be on the private network in this hot market?
Great question. Yeah.
The private network is one where largely only agents get to see that they're listed. We're the only ones with the view. There are Zenlist. If you sign up with one of us and go on Zenlist, you can see private listings. But wow, to waste the exposure that right now is existing in real estate is surprising.
We're going to talk to Carol in a minute about how many loan applications she's getting and how that affects all these numbers as well. Mm-hmm. Remember, we're at an all-time high of $1,490,000 in single-family home prices, and we only have 1.7 months of inventory. There is nothing on the market. Okay, attached condos, co-ops, townhomes up a little bit from last year. Again, inventory is low. 885 is another strong number for the first 2 weeks. And again, 473 of the 885 under contract. So we have buyers out there. 465 is our median sales price at an all-time high. And only 2.1 months of inventory in condos in our area. We'll get into mortgage rates in a minute. This was Friday's Freddie Mac average, 6.35. Okay, and here's where I want to get into talking about, this slide was there last week, where buyers in the blue are outpacing sellers in the Midwest, which is the second couple from the left. And you'll see in the South and the West, the sellers are outpacing the buyers. And this is resulting in a change in prices year over year, and it varies by region. And we're not quite as strong as the middle Atlantic states like New York, but we are very, very strong in terms of price growth regionally. Okay, this is where it gets into the economic stuff. And I'm not an economic guru, so I really have to lean into KCM, which is our most accurate real estate news forecaster. Inflation remains elevated. Unemployment is still holding steady, but job growth is stalling out. And so, for all those reasons, they say that people are worrying about an upcoming recession. And it says, according to KCM, nearly 2 in 3 Americans think a recession is coming. So the question is, what does that mean for you, buyers and sellers? First of all, the Fed is in a tough spot, says Daryl Fairweather. You know, they may or may not drop rates. Carol Ann may have better insight on that. And they've already anticipated one drop, and interest rates have that built in, according to him. So most people expect 2 federal fund rate cuts this year. And here's the anticipation between Fannie, Wells Fargo, and the average of all three on the far right, Q3, Q4, 2026 anticipated rates. So you can see the average is by the end of the year, 6.55. We're already below that, but it may come back up. So, and 6.4 is what they had done. And this was prepared a week ago. Okay. But again, if we go into the recession that they predict we will, this chart shows you that home prices may dip or be steady for a while, but they always come back. After every dip, there's a recovery. And this shows a chart that shows you that, you know, after, here, we'll just take one, the early 1980s. There were 4 million sales that year. And then when there was the recession, they went into 2 million, but then they came back. It took 4 years to recover, and then numbers were up. And as you can see from here, prices just go up. I know I'm going through this.
Really big dips. They were small dips.
Yeah.
So, you know,
exactly right.
Buyers, don't try and time your purchase based on a dip, because it's not going to be a significant.
Exactly right. Yes. Thank you.
We don't know that. We've been forecasting recession for as long as I've been in the real estate business, and we haven't really had one other than that mini one around the pandemic.
Yeah, isn't that the truth? So then this chart shows home price expectations, and toward the far right, you can see the next year or so, and you can see somebody even said 27% increase in prices. What? So the point is, nobody's anticipating prices to decline. And that's it. That's out. That's my 30-second what's going on in the real estate market. Okay.
Yeah, lots of good information though.
Okay, but now I want to bring it home.
Yeah, bring it home.
Let's talk about what's going on in Chicago.
Yeah. And you're like the canary in the coal mine. Tell us what's going on with applications.
So last weekend, I was busier than I have been, probably busier than any weekend, even in the spring market. Wow. So yes. And, you know, talking with other people at Key Mortgage, I'm not alone. I'm not like out on an island. Everybody was really busy last weekend. I think as a company, we're putting on more applications per day in the last 10 days. So something is definitely in the air, and we kind of know what one thing might be is we've got these rates that have dropped.
So Carolyn, what of your new applications, what percent of those are new home purchases versus refis?
Oh, I have like 95% purchase.
Okay.
I'm not really. Now I have a few refinances, and I'm trying to stay afloat with the requests coming in to refinance. As a matter of fact, we have a big meeting this morning about how to handle it, right? Because I have so many purchase contracts coming in that, it's like the refinances, they're going to be there. Obviously, as you guys know, the purchase contracts do have to kind of trump in terms of the importance, the timing of them. Correct. Right. We've got contingency dates to meet and such. So there are some, people that I'm sure that are just going through their past clients and doing refinances, but I'm talking the purchase market. And of course we don't know. Yes. Are there buyers that just decided they didn't want to get into the frenzy of what was going on in the spring and the summer in terms of the multiple offers? And so they decided to wait. And now all of a sudden they're coming out, and good for them that they did, right? Because now they've got this nice drop in the interest rate. So let's kind of talk about what's happened and where we're at and what does it really mean to the consumer. So, 6 months ago, we're hovering in the low 7s, and we had been kind of bouncing around in that area for, a good part of the last year. And buyers did obviously start wrapping their heads around them, right? Because the spring market was busy and we had multiple offers and people were buying. But here we are now. We are hovering in the low 6s. And, that's a significant change in somebody's monthly payment. If we do the math on, let's just say an average, $500,000 loan amount, we're talking about approximately $250 a month, $250 a month savings.
Yeah.
It's big. It's big. And so, I think even just the, we talk about the psychological effect of an interest rate, because let's face it, not everybody's out there necessarily crunching those numbers, but they hear the low 6s and it's just like, get off the couch and go to an open house. So I really think that's what's happening. And I also think that it's those people that, that purchased during the pandemic and have that 3% interest rate that have been, quote unquote, suffering through not having that extra bathroom or bedroom that their changes in their family have really needed. And they are now saying, okay, they can wrap their heads around the 6.125, the 7.125 going from 3%. It's like, it's that whole game as well. So we're closing the gap on the people who have not been wanting to sell or move that really needed to because of the interest rate. So I think that's a big thing that's going on as well. Yeah.
Okay.
Yeah, go ahead.
Well, and this is all anecdotal, but my experience is that the lack of sellers is less due to the interest rate. I mean, there is some of the interest rate, but it's also, where am I going to go? There's not enough to go to. So freeing up, getting more people to free up their properties will allow people to say, oh, okay.
Right.
Money is what I've got someplace that'll be nice I can go to.
Yeah, I'm just curious too, Carol Ann, how many pre-approvals have you done where you've seen multiple offers in the last week?
Yeah, great question. So I'm still seeing multiple offers, but not as many. So a property may have 2 or 3.
Okay.
I've definitely had a few in the last weekend where they were the only offer. So it seems less competitive, but still healthy. I mean, still,
Right.
Yeah. And it is interesting, that slide that you put up about what's going on around the country. I have a colleague of mine who they had their house listed in Virginia, in the Virginia area outside of DC. And I mean, they had to take it off the market. They just can't sell it. So single family house, it's just not, it's very different than what we're having here. So, which is obviously a good thing here, but yeah.
So are you seeing, because my guess is you're your business covers all over the Chicago area, suburb city. Are the suburbs still as hot as they were this spring, or is it this? Because when I'm finding Lincoln Park is so busy. Where have you noticed the hotspots? And I understand you're just a slice of it, but what do you?
Yeah, yeah. I see. I because I'm in several of the different offices. I do have like a pretty good variety, right, between the North Shore, the West Suburbs, the city, and I would say it's the same thing. It's kind of modeling the spring in the sense that there's still a lineup in Oak Park when a single a good move-in ready house goes on, but instead of 8 offers, there's 3. Same. So I would say the same thing. In those hot areas, Lincoln Park. In those walk-ups in Lincoln Park, I have one right now. I think yesterday, and still over ask 75,000, whatever. That's still going on, but not as many offers. So yeah.
Wow.
So yeah, so that's one thing that's interesting. And gosh, I've been waiting a long time to get on this show and talk about something good when it comes to rates. So I'm feeling a little bit like a rock star at the moment. No.
What other things should we know, Carol Ann, about what's going on with loans? Any special loan programs going on? Any
Yeah. So let's talk about another little thing that maybe some people have started to hear about. There's a little bit of chatter about Fannie Mae and Freddie Mac, and what's going to happen to them and what did happen to them back in the 2008. So just a little recap for people. Back in 2008, during the housing crash, the Fannie and Freddie were taken into conservatorship by the federal government. And so the federal government is, basically backing, U.S. mortgages. And the plan was that the end date was set that they would come out of conservatorship in 2015. And here we are today, and Fannie and Freddie are still in conservatorship. And there is some chatter about them, about there being an IPO, an individual public offering, and them going back to the private sector. And so it has not been decided, first of all. So this is all just hypothetical if this happens. And so what does it mean? And the question is, and I think one of the reasons why it has not been done yet is because it is a massive undertaking. And there are so many unknowns about what could happen that, it's kind of like you get stuck, like any other major decision, right? There's potentially some good things, right? For the government, they could, get a considerable amount of money, and the taxpayers wouldn't be responsible for that, for the housing market, for the mortgages. But in general, there's just so many unknowns that, we don't need to necessarily dig into all of the pros and cons, but I wanted to just bring it up because it is a potential and people are starting to talk about it. And unfortunately, we just don't know, A, if it's going to happen, and B, if it does, it's very hard to predict whether it's going to be positive or negative and who it's going to be positive or negative for. But in general, will it impact the housing market? Yes, it will. That's for sure.
What role does Fannie Mae play in setting mortgage rates, if any?
Well, they're setting the mortgage rates, right? The investor, they're more like the policy behind it, right? So Fannie Mae is setting the guidelines that all lenders have to use when doing a conventional loan, and so it's more about the policy and the terms. And then, in terms of the interest rate, it's more about the market and how the market interprets it. So I think that's probably, where we should kind of leave that.
There isn't one mortgage rate.
No. Yeah. So this is more about policy driven and, how it's set up. Like right now, it's the government is behind the setting up the guidelines and all that.
Well, now that brings up an interesting question, because Kyle, you and I have talked about unwarrantable buildings.
Yes.
And if Fannie were to get very strict about what a condo must be in order to have conventional financing, that could have, and of course, I shouldn't even be bringing this up because I don't want anybody to think this is going to happen. But
Well, actually,
yeah, you know what I'm saying? I mean, look after Florida, after they put in that requirement for inspections to make sure the building's not going to collapse, right?
Oh, it's completely changed the condo financing market.
I think actually the reason that they want to IPO again, Fannie and Freddie, is to get it away from the government so that the government doesn't have to impose things like the rules that came after the crash in Florida, after the building collapse in Florida. I think rules will loosen.
You think so, huh?
Oh, absolutely. It's because the federal government was on the hook that the rules tightened. I think the goal of all of this is perhaps less regulation rather than more regulation. I don't think Fannie and Freddie necessarily want all this. This is being imposed by the need to address risk, or the perceived need to address risk, and that this is the way you address risk. But you were thinking just what I was thinking about, unwarrantable buildings and all of those questions. So that's very interesting. So we'll just keep our ears open for that.
Yeah, we'll keep our ears open, and if we get anything more serious in terms of what's going to happen, we could definitely come back and talk about it. But I think for now, it's just let's it's a wait and see. It's a wait and see.
So you've come on in the past and shared with us the great news that the state of Illinois and other places have had down payment assistance programs. Is there any taste for that anymore? Because that was really helpful to people. Those were really great programs.
Yeah.
Year, what are you thinking?
So in the state of Illinois, we still have our IDA program. Yep. Things that the what?
Is there still money in it?
Yep.
Oh, good.
Yep. So IDA, ihda.org. That program is still funded. And, a lot of people are asking me, is it in jeopardy with this administration? Who knows? But I mean, it's a state program. So right now we're good. And Cook County did have a great program. It lasted, like 5 minutes practically. No, I'm just kidding. But yeah, the funds went pretty quickly for that program that was out this summer. So those are the kind of programs that kind of come in and go out. But IDA has been very steady. And we are, Key Mortgage we are an IDA representative. So we do IDA loans. And so those are great for some people, not for everybody. But yeah.
So contact Caroline if you want more information on what's available to you.
Right. Yeah, and I think the most interesting thing too, with rates is watching, like those slides that Ann had put up. The Fed is already built in, in terms of, but any Fed meeting, any Fed talk, anything, this is a big week, right? We could give back pricing, which we did a little bit on Friday. On Friday, rates ticked back up in eighth, so 0.125, so nothing dramatic. So we hope that this week doesn't bring more of that, because we did have we had a dip. Actually, it's funny because one of my refinance clients that just came back to me again, the last time I was looking at our email exchange, the last time we talked about this was just about a year ago, where we had a dip. She thought, well, maybe should I refinance? There wasn't quite enough for it to make sense. But it's ironic that it was exactly a year ago that we had this conversation. So one of the things that I really do want to say, probably the most important thing that I want to say today, is obviously we're so happy about where we are with rates, but do not get complacent that these rates are going to stay here and just continue to drop. Yeah. This is a great window right now. So this is like a call to action. If you are an agent, this is the time to go through your clients that are on the fence, that that maybe said they didn't want to buy, and just get back in touch with them. If you're a buyer, don't sit around and wait for these rates to drop more, right? This is potentially an opportunity right now. And we just can't guarantee that these rates are going to stay here or drop lower. So
you're telling all your clients to lock this week.
Absolutely. And because all my clients, I had a lot of clients go under contract last week. And when you go under contract, that's the first opportunity that you can lock in your interest rate. So when you are shopping and you're just pre-approved and you're looking at properties, the interest rate doesn't really matter, because it might not be there when you go under contract, because some people, right, it takes a while. So you're under contract, and so we lock in the interest rate. Key Mortgage has what we call a rate renegotiation policy. Once you get within 15 days of closing, we get to revisit where the current rate is. And if the rate has dropped significantly, it's like a safety net, right? If the market has fallen and the rate has dropped, we've got a threshold. It's an equation. I don't know exactly what it is, but it's roughly 0.25%.
Wow.
You get the lower rate for no fee. So I have some people closing this week that just took advantage of this, that
For
they
them.
thought their payment was going to be this. They signed all of their closing paperwork with, my mortgage payment is going to be X. And it's like, now your payment's going to be lower. It's great.
Another reason to love Key Mortgage, huh?
That's right.
That is an awesome thing. I didn't know about that.
Yeah.
So I've been getting questions from people who are who want to get in the market, understand the timing, are very excited, but they're really concerned that they have so much student debt still, and for a while. And how do you counsel people who are concerned about their level of student loans?
Well, we have to take a look at it. So student loans, especially that they're not paying on, which they are paying or are not?
They are.
Oh, okay. Because there's still a lot of people that have, because of the loan program, that have, they're waiting to hear about what's going on with these special loans, right? So they're not paying. It's all about debt to income ratio. So if you have a lot of student loan debts, then you want to keep all of your other liabilities as low as possible.
Right.
So holding off on that expensive car payment, if you can, keeping your revolving debt low. So it's just a balance.
Okay, so you really give advice to people on how to be best positioned to be approved for a mortgage.
Yeah, for sure. Oh yeah, I do consultations all the time. Like, you're not ready now, let's talk about what you need to do to get ready. And so that's, and it's interesting because it's like, I don't know, I was reading an article yesterday about, when kids graduate college, one of the first things they want to do is go buy that car. And then they go to buy a house and they realize they've got this $800 car payment. And it's like, that really, really hits your debt to income ratio. So
are you using any number? I mean, I used to do the old 28-36. What ratio, if somebody is self-analyzing, do you recommend they consider?
What do you mean?
Total debt.
Well, I mean, you have to be under 50. So your debt to income ratio.
Of gross income? Oh, that's
Yeah.
insanely high to me, but okay.
Well, it is. Yeah. It's insanely high, but that's what we use to qualify.
Really?
So it doesn't mean you want to be that high, but yeah.
Wow.
Yeah.
So with a good credit score and even up to 50%, you can still buy something.
Well, because so think about the people that are wanting to buy before they sell.
A lot, yeah.
That's where, right? If it was 30, nobody would be able to do that.
Right.
Yeah.
Okay.
And that's another thing you've talked to us about in the past, and maybe we can do this on our next show, is buy before you sell programs, and how you advise clients.
Yeah.
People always want to hear it.
All right. Yeah. Any last words, Carol Ann? Advice for buyers or sellers?
call, this is like, get off the couch, call to action. Now's the time. That's really, really how I feel right now, because it's not as competitive and your rate is lower.
Thank you so much, Carol Ann.
You're so welcome, ladies.
Everybody, thank you for watching. This has been Monday Morning Coffee with Kyle and Ann. And on behalf of Kyle and Carol Ann, we thank you. And please get in touch with us if you have any questions. Have a great week, everybody.